Welcome to our discussion on the best 3 ETFs to buy and invest in 2025. Let's begin with the basics. ETFs, or exchange-traded funds, are a type of security that involves a collection of securities, such as stocks, that often track an underlying index. They are similar to mutual funds, but are traded on exchanges just like individual stocks. This means they have all the benefits of broad diversification that mutual funds offer, while still maintaining the flexibility to be bought and sold throughout the trading day at fluctuating prices. One of the main benefits of ETFs is that they allow you to invest in a wide array of assets, without having to buy each one individually. This can significantly reduce the risk associated with investing, as the impact of any single security's performance is lessened. Plus, ETFs can be more cost-effective as they generally have lower fees than mutual funds. Diversification is a key principle in investing. It's the old adage of not putting all your eggs in one basket. By spreading your investments across various types of assets, you can potentially reduce the risk and increase the potential for returns. Now, we're going to be focusing on 3 specific ETFs in this video: ITOT, VTV, and SPHD. Each of these has shown promising performance and offer unique advantages for investors. ITOT, or the iShares Core S&P Total U.S. Stock Market ETF, aims to track the investment results of the S&P Total Market Index, which comprises a broad spectrum of U.S. stocks. VTV, known as the Vanguard Value ETF, seeks to track the performance of the CRSP U.S. Large Cap Value Index, which measures the investment return of large capitalization value stocks. Lastly, we have SPHD, the Invesco S&P 500 High Dividend Low Volatility ETF, which is designed to track the performance of approximately 50 stocks that are both low in volatility and high in dividend yield. Now let's dive into these top-performing ETFs and see what they can offer to your investment portfolio in 2025. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First on our list is ITOT, the iShares Core S&P Total U.S. Stock Market ETF. ITOT, a product of BlackRock's iShares, is a popular exchange-traded fund that gives investors exposure to a wide swath of the U.S. equity market. It tracks the S&P Total Market Index, which encompasses all U.S. publicly traded stocks, from the largest corporations to the tiniest startups. The beauty of ITOT lies in its diversification. It's like purchasing a tiny piece of the entire U.S. stock market, spreading your investment across a range of sectors and company sizes. This wide exposure can help to mitigate risk, as losses in one sector could potentially be offset by gains in another. It's a way of putting all your eggs in different baskets, so to speak. Now let's talk about performance. Since its inception in 2004, ITOT has provided consistent returns, closely mirroring the performance of the U.S. stock market as a whole. It has a history of stable growth, with an average annual return of around 7% over the past decade. However, like any investment, past performance is not a guarantee of future results, and there are risks associated with investing in the stock market. Speaking of risks, ITOT is considered a relatively low-risk ETF due to its broad diversification. But it's important to remember that low risk does not mean no risk. The value of ITOT can fluctuate with the overall market, and there is always the potential for loss as well as gain. ITOT is also known for its focus on large-cap U.S. stocks. These are companies with a market capitalization of $10 billion or more, and they often make up a significant portion of the fund's holdings. This focus on large-cap stocks can provide a level of stability, as these companies are typically more established and less volatile than their smaller counterparts. But perhaps one of the most attractive features of ITOT is its low expense ratio. The expense ratio is the annual fee that all funds or ETFs charge their shareholders, and it represents a percentage of your investment. ITOT's expense ratio is just 0.03%, one of the lowest in the industry. This means more of your money goes towards your investment, not fees. So, to sum up, ITOT offers a way to invest in the entire U.S. stock market with a single purchase. It provides broad diversification, a focus on large-cap stocks, and a low expense ratio, making it a solid choice for those looking for wide market coverage. With a low expense ratio and a broad-based exposure to U.S. stocks, ITOT is a solid choice for investors seeking wide market coverage. Next, we have VTV, the Vanguard Value ETF. This fund has carved out a niche in the ETF landscape with its focus on large-cap U.S. value stocks, a segment known for its resilience and competitive performance. Now let's take a closer look at VTV. At the heart of this fund is a selection of value stocks, companies that are considered undervalued in relation to their intrinsic value. These are the stocks that have been overlooked in the market frenzy but hold immense potential for returns in the long run. VTV's performance has been commendable. Over the past decade, it has consistently outperformed the broader market, demonstrating the robustness of its investment strategy. The fund's return on investment has been steadily climbing, proving its worth as a reliable vehicle for long-term growth. But what about risk? Investing always comes with its share of uncertainties. With VTV, however, the risk level is relatively lower. This is primarily due to its focus on large-cap stocks, which are typically more stable and less volatile than their smaller counterparts. These large-cap companies have proven business models and a history of weathering market downturns, making them a safer bet in turbulent times. Moreover, VTV has an added layer of protection in its diversification. The fund is spread across a variety of sectors, reducing the impact of any single sector's downturn on the overall portfolio. This broad exposure serves as a buffer against market volatility, further lowering the risk level. Now let's talk about potential returns. VTV's focus on value stocks provides unique opportunities for investors. These stocks, often overlooked by the market, can offer substantial returns when their true value is recognized. And while these returns may not be as flashy as those of high-growth stocks, they tend to be more stable and consistent, providing a steady stream of income for investors. In addition, VTV offers an attractive dividend yield. This adds a regular income component to the potential capital appreciation, making it an excellent choice for income-focused investors. So, what does this all mean for you as an investor? VTV offers a unique blend of value, stability, and potential returns. Its focus on large-cap value stocks provides a stable foundation, while its diversified portfolio offers protection against market volatility. The fund's consistent performance and attractive dividend yield make it a compelling option for both growth and income investors. In conclusion, VTV is a great option for investors who want to focus on value stocks, with a lower risk profile and steady returns. It offers the opportunity to invest in resilient large-cap companies at a bargain, with the potential for consistent growth and regular income. It's a fund that truly embodies the essence of value investing, making it a worthy contender in any investor's portfolio. VTV is a great option for investors who want to focus on value stocks with a lower risk profile and steady returns. Lastly, let's explore SPHD, the Invesco S&P 500 High Dividend Low Volatility ETF. As the name suggests, this ETF is all about finding the sweet spot between receiving a steady income and ensuring a smooth sailing investment journey. It does this by focusing on two key factors: high dividends and low volatility. But what does this mean exactly? Well, in the world of investing, dividends are basically a portion of a company's earnings that are paid out to shareholders. High dividend stocks, therefore, are those that regularly pay out larger dividends to their shareholders. This can be a great way to generate a steady income, especially for those who are nearing retirement or simply want to supplement their regular earnings. On the other hand, low volatility stocks are those that have less dramatic price swings. They tend to be more stable and less susceptible to market fluctuations. This stability can be a boon for investors who prefer a less risky investment strategy. So SPHD combines these two factors by investing in the 50 highest dividend-yielding securities in the S&P 500 that also have the lowest volatility. By doing so, it offers a unique blend of income and stability that can be attractive to a wide range of investors. Now let's talk about performance. Over the past 5 years, SPHD has delivered an average annual return of around 4%. While this may not seem like a lot compared to some other ETFs, it's important to remember that SPHD's main draw is its stability and income potential, not necessarily its growth potential. In terms of risk, SPHD falls on the lower end of the spectrum. This is due in part to its focus on low volatility stocks. However, like all investments, it's not without its risks. For instance, while high dividend stocks can provide a steady income, they can also be more susceptible to economic downturns. This is because companies may choose to cut their dividends during tough times to preserve cash. Despite these risks, SPHD can still offer a compelling investment opportunity for those looking for a balance between income and stability. Its unique investment strategy can provide a steady income stream and a buffer against market volatility, making it a potential cornerstone for any well-diversified portfolio. So, whether you're a seasoned investor looking to diversify your portfolio or a newbie just starting out on your investment journey, SPHD could be a great ETF to consider. Of course, as with any investment, it's always important to do your own research and consider your own financial circumstances and risk tolerance before making a decision. SPHD could be a great addition to your portfolio if you're looking for a balance between income and stability. Now that we've individually looked at ITOT, VTV, and SPHD, let's compare and contrast them. In the vast universe of exchange-traded funds, or ETFs, ITOT, VTV, and SPHD each offer unique advantages and considerations for investors. As we dive into the comparison, remember your investment choice should align with your financial goals, risk tolerance, and investment horizon. Let's start by evaluating each ETF's performance. The iShares Core S&P Total U.S. Stock Market ETF, or ITOT, aims to track the performance of the S&P Total Market Index. This means ITOT provides broad exposure to the entire U.S. stock market, including large, mid, and small-cap equities. Over the years, ITOT has demonstrated consistent performance, closely mirroring the ebbs and flows of the overall U.S. market. Conversely, the Vanguard Value ETF, or VTV, focuses on large-cap U.S. stocks that are considered undervalued compared to the market. VTV's performance can fluctuate more significantly than ITOT's, particularly if the market shifts away from favoring value stocks. However, when value stocks are in favor, VTV has the potential to outperform ITOT. Lastly, the Invesco S&P 500 High Dividend Low Volatility ETF, or SPHD, aims to track the performance of 50 of the least volatile high dividend yielding S&P 500 companies. Its performance is tied to these specific companies and their ability to maintain high dividends. So, while SPHD's returns may not always match the overall market, it can provide a steady stream of income, which can be particularly attractive during volatile market periods. Now let's discuss risk. ITOT, given its broad market exposure, carries a level of risk equivalent to the overall market. This broad diversification can help mitigate the impact of any single company's poor performance. VTV, on the other hand, carries a slightly higher risk due to its focus on value stocks. These stocks, often from companies facing short-term challenges, can experience more significant price swings. However, the flip side of this risk is the potential for greater returns if these companies bounce back. SPHD is designed to reduce risk by focusing on low-volatility, high-dividend stocks. These companies are often more stable and less likely to experience significant price swings. However, this focus on stability can also limit SPHD's potential for high returns. Moving on to potential returns, ITOT has the potential to generate returns equivalent to the overall market. However, it's worth noting that this also means it's subject to the market's downturns. VTV, due to its focus on value stocks, has the potential for higher returns. If these undervalued companies recover and their stock prices increase, VTV could outperform the broader market. However, this potential comes with the caveat of higher risk. SPHD, with its focus on high dividend, low volatility stocks, provides a steady stream of income through dividends. While its price appreciation may not be as high as ITOT or VTV, the consistent dividend income can be appealing, especially to income-focused investors. So who might prefer each ETF? ITOT could be a good fit for investors seeking broad market exposure and who are comfortable with market-level risk. VTV may appeal to those willing to take on a bit more risk for the potential of higher returns. And SPHD could be attractive to investors seeking a steady income stream and lower volatility. Remember, the best ETF for you depends on your financial goals, risk tolerance, and investment horizon. Each of these ETFs offers different benefits and risks, and what works best for you might not work best for another investor. The key is to understand your investment goals and choose the ETF that best aligns with those goals. Happy investing! We've covered quite a bit of ground today, discussing ITOT, VTV, and SPHD. In our journey, we've traversed the landscape of exchange-traded funds, delving into the unique characteristics and benefits of each of these three ETFs. Let's take a moment to revisit the salient points we've discussed. Starting with ITOT, we've explored how this ETF offers broad exposure to the US stock market. With its focus on tracking the S&P Total Market Index, ITOT provides an opportunity to invest in a wide range of sectors, making it an excellent choice for those looking for diversified exposure to the US equity market. It's a comprehensive one-stop shop for your investing needs. Next, we've ventured into the territory of VTV, the Vanguard Value ETF. This fund is designed for investors seeking value stocks, which are shares in companies that are considered undervalued compared to their intrinsic value. VTV is a solid choice for those who believe in the potential of these value stocks and are willing to wait patiently for the market to recognize their worth. Then we turned our spotlight on SPHD, the Invesco S&P 500 High Dividend Low Volatility ETF. This fund is all about balance. It aims to provide investors with a regular income stream through high dividend yielding stocks while minimizing risk with its focus on low volatility stocks. For those seeking a steady stream of income and a hedge against market volatility, SPHD could be an appealing option. As we've seen, each of these three ETFs has its unique strengths and can serve different investment objectives. But remember, it's not just about picking one ETF over the other. It's about how each of these funds can fit into your overall investment strategy. Diversification, as we've discussed, is key. By spreading your investments across different types of assets, you can potentially reduce risk and smooth out the ups and downs of the market. ITOT, VTV, and SPHD can each play a role in a diversified portfolio, serving as a counterbalance to each other. But it's also crucial to consider your personal financial goals. Are you investing for the long term, saving for retirement, or looking for a steady income stream? Your goals should guide your investment decisions. Not every ETF will be suitable for every investor. It's important to understand your own financial situation and risk tolerance before making these decisions. And of course, always remember that investing involves risks, including the possible loss of principal. While ETFs can provide a practical way to diversify your investments, they are not immune to market fluctuations. It's essential to do your own research or consult with a financial advisor before making any investment decisions. In conclusion, ITOT, VTV, and SPHD each offer unique opportunities for investors. Whether you're seeking broad market exposure, the potential of value stocks, or a balance of income and stability, these ETFs can play a role in your investment strategy. Thank you for joining us in this discussion. Don't forget to subscribe, like, and share our content if you found it useful. Stay tuned for more insightful discussions on investing.